Liquidia Corporation just posted its fourth straight profitable quarter, but the release itself warns United Therapeutics could get a court order that wipes out essentially all of their revenue overnight. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Liquidia Corporation gets graded and traded. So on the headline, revenue came in about 2.3% ahead of estimates. That sounds small, but the story underneath is huge. YUTREPIA net product sales hit $170.4 million, up 31% just from last quarter and up from basically nothing a year ago when the drug had barely launched. On the EPS line, they actually missed by about 8.6%, but here's the context. This company posted $74.7 million in net income and swung from a $41 million loss in the same quarter last year. So a small miss on the estimate, but the underlying earnings picture is night and day. So on the beat itself, this earns a D. The rule is the rule. A 2% revenue beat paired with an EPS miss doesn't clear the bar for a strong grade, even when the underlying business momentum is obviously there. And on consistency, this earns a C. Their track record of beating estimates is mixed, and this quarter's EPS miss keeps that pattern from tightening up. Let's talk about the positives from the report. YUTREPIA sales hit $170.4 million this quarter, up 31% from last quarter alone. And remember, a year ago this drug had just launched and did $6.5 million. So the ramp here is genuinely impressive. Fourth straight quarter of expanding profitability. Net income of $74.7 million. Adjusted EBITDA of $96.3 million. This company has clearly flipped from burning cash to printing it. Cash on the balance sheet grew to $284 million, up $61 million in just one quarter. That means they can fund all their research without needing to sell more stock, which is huge for a biotech. Underneath the revenue number, the commercial metrics are strong, about 5,900 unique patient prescriptions since launch, over 1,100 physicians prescribing it, and the prescription to start conversion is running above 85%. Doctors and patients are actually sticking with the drug, and they're not sitting still. The pivotal trial for their next drug, L606, is now enrolling patients, plus they've got 10 total clinical studies going. That's a real pipeline building on top of the current commercial success. So on profitability, this earns an A. Fourth consecutive quarter of expanding margins, $96 million in adjusted EBITDA, and a clean swing from a big loss a year ago. This is textbook operating leverage kicking in. Now, let's talk about the negatives from the report. The single biggest one is the ongoing patent lawsuit with United Therapeutics. The release itself warns that UT is seeking a court order that could block Liquidia from selling YUTREPIA for one or both of its approved uses. If that happens, essentially all product revenue disappears overnight. Operating expenses are scaling fast. Research and development was up 185% year over year to $17.2 million, and selling, general, and administrative expenses was up 48% to $57.4 million. Some of this is normal for a company ramping up, but it's a real cost line to watch. They're now paying income taxes. $7 million this quarter versus $0 a year ago. That means their built-up tax shield from prior losses is running out, and future profits are going to face a growing tax bill. The legacy partnership revenue with Sandoz shrunk to $1.3 million from $2.3 million a year ago, so the older generic business isn't contributing meaningful growth anymore. And the concentration risk is extreme. Basically, 100% of product revenue comes from a single drug, and that drug's commercial future is being actively litigated. L606 is years away from potentially getting approved. On guidance, This lands at a C. The press release didn't include forward revenue or EBITDA numbers, so this is reduced visibility, not evasion. I expect them to address forward guidance on the earnings call. And on red flags, I'm at a D. The commercial print is strong, but the UT injunction risk, sitting on top of 100% of product revenue, is a binary event I can't dismiss. That's a serious concern. Putting it all together, this is a genuinely strong quarter operationally. YUTREPIA is winning, profitability is real, and the balance sheet is loaded. But there's a lawsuit hanging over the whole business that could wipe out essentially all revenue if it goes the wrong way, and that risk dominates everything. So I'm giving this print a C. Great execution, real tail risk. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The business side here looks strong to me, with a $170.4 million quarter backing up the story, but the legal risk sits right next to it, and the company itself flags it in the release. If I'm starting fresh, I'm keeping the position small enough that a worst-case court outcome doesn't blow up my account, or I'm just waiting on the ongoing patent case before I commit real money. Instead of buying shares straight up, I'd rather sell cash-secured puts way out of the money, collect some premium, and let the market pay me while I wait for a better entry. So for me, it's a small starter position, or I wait on the ruling before doing anything bigger. The operational strength here is real, and I think it justifies collecting some premium, but I'm setting my strike floor assuming a bad ruling on the patent case could cut this stock in half. Any strike closer than 20 to 25% out of the money basically means I'm accepting the full legal risk in exchange for that premium, and I'm not sure the premium is paying me enough for that trade. If I'm going to sell a put here, it has to be at a strike, where I'd genuinely be fine owning the shares, even if the drug sales get disrupted by the courts. So I'm only selling strikes I'd actually want to own through a bad ruling. If I own shares here, I'm holding, because the quarter validated the thesis with sequential revenue up 31% and the operational story is intact. Cash grew by $61.4 million, and profitability has been compounding for a 4th straight quarter, so the business itself is supporting the current share price on the merits. The only reason I'd trim a piece of my position is if the stock has grown too large relative to the rest of my portfolio, purely as risk management against the legal overhang, not because anything is broken with the business. So I'm holding and maybe trimming if my position got too big. If these were my covered calls, the commercial momentum tells me I shouldn't let my shares get called away cheap, so I'm looking to roll them up and out instead. Sales were up 31% sequentially, and the company is sitting on $284.2 million in cash, so the fundamental case supports a higher share price even if the legal cloud caps the multiple. If my calls are sitting near the money right now, I'd rather close them early and resell further out of the money, so I keep my upside if the court ruling goes the right way. So I'm rolling up and out to keep my upside intact. The print here validated the operational side of my long-dated call thesis, but it did nothing to resolve the legal risk that really shapes the 12 to 24-month view. I have to be honest with myself that the terminal value of these long-dated contracts is dominated by the outcome of the patent case, not by how well the drug is selling right now. If my long-dated calls are meaningfully in the money on the operational strength, I think taking partial profits and rolling the rest further out in time or higher in strike is a reasonable way to lock in gains while keeping upside on a good ruling. So I'm holding and taking some profits off the table if I'm deep in the money. The second quarter release validated the underlying business thesis for me, with sequential revenue growth of 31% and 4 straight quarters of expanding profitability. The growing patient base tells me the drug is winning share as the inhaled treatment of choice, so operationally, there's a real case for adding here. But I'd only average down if my original thesis already accounted for the patent litigation risk that this release flags again. Because if the legal side wasn't in my original work, this print isn't a green light, it's a signal to redo my homework. So I only add if the legal risk was already part of my original thesis. Bottom line, this print earns a C from me. The commercial launch is working and the profitability is compounding, but the United Therapeutics litigation is a binary event that overshadows the whole trade. Position sizing here has to respect that risk. Thanks for watching, and I'll see you on the next one.